Thank you for downloading this episode of Your Life Simplified. My name is Brian Leitner, and I'll be your host on today's podcast. This podcast is being aired during tax season, and tax season brings about stress for a lot of us. It is obviously trying to get our taxes done not only the right way, but have them done by the specific deadlines, such as April 15th, and if you extend, that can go into August and so forth. But again, it creates stress for individuals, and candidly, it creates stress for those that are preparing the taxes themselves, because this is just a really busy time of the year. But in light of that, and understanding the feelings that people have as it relates to tax filing, what I thought we'd do is we talk about a few of the things that generally come up around this time, but specifically this year, because there's been some changes to the tax law, as we all know, and this is really the first year where we're filing based upon those tax changes in 2018. So in today's episode, we'll talk a little bit about the changes that have been made and maybe how to plan or prepare your taxes based upon those changes in tax law. We'll also talk about mistakes that are made. We'll also talk about ways in which to find a professional that can help you prepare your taxes and also delineate between tax preparers and those that truly provide tax advice. So on today's show, I'm really excited to introduce Erin and Ryan from Mariner Wealth Advisors. Guys, thanks for joining us on the show. Erin, would you just take maybe a minute to introduce yourself and your background?
Yeah, of course. Thanks, Brian. My name is Erin Alexander. I'm a senior tax manager here at Mariner Wealth Advisors. Typically, my job is, we work a lot with clients, tax strategies, a lot of compliance work, and kind of year-end planning.
Thanks, Erin. Ryan?
Yeah, my name is Ryan Drake. I work at Mariner alongside Erin as well, also a senior manager. I would say my background's pretty similar. We do primarily high net worth individual planning, family partnerships, investment partnerships, a lot of projections and consulting throughout the year, just to help people save as much tax as they can.
So guys, first and foremost, I do want to thank you. I know it is the beginning of tax season. You guys are about to get very, very, very busy. So I appreciate you being here, appreciate your expertise. I think there are a lot of folks that can benefit from the knowledge that you guys have as they begin to dive into this year's tax season. So Ryan, maybe we'll start the first question with you. This is the first tax season that folks are dealing with under the new tax law. So can you provide us maybe a broad overview on some of the changes that people need to be thinking about?
Sure. Yeah, it's kind of a dawning overhaul. You keep hearing for the last year and 3 months or so that this is the biggest change since 1986. And for those of us in the industry, we certainly understand that. For those that are just everyday clients, though, a little bit more insight's kind of helpful. Everyone's really focused on Schedule A itemized deductions and some new concepts on investor relations with what they can do with maybe capital gains or what their charitable deductions are going to look like, which goes back to the itemized deductions. But there's just a lot of nuances that have come out over the last year. And one of the biggest problems with any kind of sweeping tax reform is the guidance is really lacking right now. So as we go through this podcast today, we're going to talk about a lot of different things that you can do and kind of think about and what a good tax consultant versus preparer will do. But just kind of to start off to think about this, if you haven't had a conversation with a tax consultant or even a tax preparer about what your deductions or your income really means under this new tax law, the next month or so before everyone gets really busy in the true avalanche of tax season, it might be a good idea just to pick up someone in your personal network, talk to your wealth advisor, talk to someone that you trust, and say, this is what I saw last year. What should I be expecting for this coming year? And in that, when we've had those conversations with clients, we've been able to kind of identify some misconceptions, some misunderstandings of what the new tax law really is and is not, and what it really does mean to them. And Erin, do you have any thoughts on what you've talked about in the last year?
Yeah, I do, Ryan. Thank you. Because of the increase in the standard deductions, $12,000 for singles and $24,000 for married filing jointly. What does that mean as far as itemizing deductions? Because in the past, many people have always itemized, but now going forward, will they? And a part of itemized deductions, a big part of it is your charitables. So now some people are thinking, if I'm limited to $10,000, for real estate and property taxes and income taxes, if I don't have a mortgage and, I'm going to automatically get a $24,000 deduction standard. So should I make any donations to charity? But I think what a lot of people don't understand is does the charitable deduction no longer benefit me? And I think that's a wrong way to think about it. There are some strategies around charitables that we can, we'll talk about probably a little later. charitable deductions, yes, they are still a benefit, and they are still good to do for tax purposes.
So, Erin, that's a great point too. And when I think people talk about, that the charities are now going to suffer because people aren't getting maybe the exact tax break they did in the past. Generally speaking, with folks I've worked with in the past, people are donating not simply for the tax deduction, right? I think in general, people want to give back. And so while we may see potentially a bit of a decrease, I think for the most part, people are going to continue to give because that's what's in their heart, right?
Right, yeah. And that's the hope. Obviously, we as a society are good people and, want to do good things.
You bet. Another thing to consider is that while they have reduced what you may be able to deduct as it relates to itemized deductions, as it relates to charity, there is something that's referred to as qualified charitable distributions, and the acronym there is QCDs. And what this does is it enables folks to take distributions directly from their IRA and donate them to a charitable organization. And it has to be done in the right manner. But when it's done this way, individuals are able to give up to $100,000, and they're able to deduct this because it falls outside of itemized deductions. So again, that might be another strategy, but keep in mind, this strategy is only available for those that are over the age of 70 and a half. So again, just something else to think about.
I think that's a great point on society being good and people still really caring about charitable deductions. I think several of the conversations I've had with clients and with personal friends as well is around the idea that their charity no longer matters or what they can do about it. And I think really what's come away from this conversation is they're concerned that they're going to be the losers in this new tax law regime. And the fun part of the conversation really turns to some of the other misconceptions. Like I was talking to my friend last week and he said, well, I'm going to lose the $20,000 my personal exemptions. And there's no way I'm going to make up for that. And I kind of took a step back and went, well, that's probably true. Like you're losing a good amount of your personal exemptions. But on the flip side, we have a lower tax bracket in most brackets. So what used to be 25 might be 22 now. What used to be 15 is 12. So your marginal rate is less, and plus the amount of taxable income in each of those brackets is wider. And so you're really being taxed less on your same amount of income. In addition to that, your family is in a situation where you've historically not gotten your child tax credits. And now you're going to get child tax credits for, in his case, $6,000. And what that does is your personal exemptions may be lost at a smaller marginal rate of 15%, let's just say. But your tax credits are now $6,000. When you do the math on that, you're actually ahead. So there's just, with a sweeping tax law, there's so many misconceptions, and it's so hard if you're just used to the same old tax profile year to year of what you know for yourself. It's hard to really judge where you're at with it.
And I think what's really interesting about that is because all these areas of tax law are so integrated, right? And so just like your friend telling you that he's going to lose this or she's going to lose that, and the reality is there's so many different components to what you ultimately end up paying as a tax liability, whether that be the exemptions or whether that be the some of the limitations on that have been removed on the itemized deductions as well. So they've removed it under that. The P's limitation no longer exists, which I know is maybe highly technical for listeners, but there's all of these different levers that are being pulled within the overall tax calculation. It really begs the question, are people looking at this truly holistically and in its entirety?
Well, I was going to say, I was like, how did you get to your $6,000 tax credit?
Oh, sorry. For the clarification point of that, $6,000 has arrived. They have 3 children that qualify. They're under 17 years of age. They live with them full year. They provide over half their support. So they are qualifying children for the new increased child tax credit. And it's $2,000 per qualifying child. 3 times 2 is $6,000.
Way to hold his feet to the fire on that in terms of disclosure, as opposed to just making facts up.
Like I said, I just don't do it as well as she does.
I was going to say, do I get a $6,000 credit? How do I get this? But
Do you have 3 kids?
I do not.
Find them with a coffee bean.
I'm a 1. I don't own anything. I'll standard deductions. This tax law actually is going to benefit me.
So guys, I know you come across a lot of different mistakes, whether that be on the new tax law or just mistakes you see on a regular basis. Can you talk a little bit about that so we can learn from that experience?
Yeah, Brian, I'll take this one. I guess I'll kind of use an example of a friend of mine when I talk about this, but a mistake that I often see is that people, you get invested in something and you don't really understand what that means for you tax-wise. Am I going to get a K-1 issued to me? Am I going to get a 1099? How is that taxable income going to be reported? And so, you either you invest yourself or your wealth advisor gets you invested in something. And you know what? You want to file your tax return, so you do it in April. And then after April, come June or July, all of a sudden you get a K-1 from some investment that you're in that, you weren't expecting. So, now you got to amend your tax return. And, along with K-1 investments, there might be new state filings that you'll need. There's also, you should research, what does this K-1 tell me? Are there footnotes? What do the footnotes mean? So just, making sure that you're recording everything correctly on your return and not missing deductions.
So Erin, great points. It's always critical to understand not only why you're investing in something, but what you're investing in. So you can understand what that total rate of return is and what that total investment is from your perspective on even completing the tax returns themselves. I know, Ryan, earlier we were talking about a particular instance as it relates to real estate and real estate investing and, the opportunity in terms of where you report that in your tax return, and you have multiple options, for argument's sake, as it relates to certain types of real estate. And so, walking us through some of the challenges you've seen or areas that people should think about if they are real estate investors.
No, I think that's a great point, a great question. So when you hold real estate, there are always great entity choices to be made. And I'm not going to try and get too technical with this, but what you usually see is someone say, I'm going to wrap my property in an LLC. And what they're saying in that is they're going to set up through some legal documents, a limited liability corporation that the title of the rental, the commercial building, whatever the real estate holding is, will be held inside that entity. Really, you do that for legal protection reason, but the other reason is for taxes. Getting in and out of LLCs, taxes, partnerships is really easy. You can distribute the properties easier without tripping tax. You can have, you can play around with some of the economics between partners on who recognizes the losses until certain capital events happen. And when you compare that with like an S Corp, which is an incorporated entity that will also provide the legal protection, S Corps are really rigid in entity structure. And the idea with rental real estate is sometimes you want to get in and out of it. It's rare that you hold something for 40, 50 years as a rental real estate person. But the problem comes in is when you try and exit that strategy with an S Corp, you end up tripping taxes a lot quicker if you want to distribute property out or break up the S Corporation than you would with a partnership.
So Ryan, thank you. Those are all great points. I think there's a lot of confusion in the areas of write-offs. There are a lot of jokes that are made as it relates to write-offs and how people can be, probably a little too greedy as it relates to write-offs. I mean, what do you see in this area, Erin?
Brian, yeah, I think greedy is very accurate for a lot of taxpayers. Business expenses, nowadays everything seems to be a business expense to someone. An example I like to use are these now social media influencers. So I don't know how many of you, follow Instagram, but, everybody is their own business. So as an influencer, that's going to be your Schedule C now on your tax return. And since your business and your job is influencing people per social media, you think you get to write everything off. Starbucks, expense, hashtag expense.
Hashtag expense.
All sounds great.
Yeah.
Take a picture of the gas pump. Hashtag expense.
Right. I would love to be an influencer. It looks like a great job. You get a lot of free stuff.
After this podcast, you very well might be.
I might be. But, to be a business expense, it typically needs to be ordinary and necessary. Other things that people kind of mess up. We had a client where their tax attorney actually recommended to them as a tax strategy to charge themselves rent expense for using their home office, as a business deduction. That's incorrect. You cannot do that. Ryan, you have anything you wanted to add?
Yeah, I think in the line of self-employed individuals, estimated tax payments are always a confusing topic and subject. So we have people that come in and they tell us that they started a business last year. They switched from being a W-2, which means that your employer's in charge of your withholding. You never have to think about what goes to the IRS generally. And now they have this independent contracting business or consulting business. And come April of the following year, they don't realize that they went the entire last year without making any kind of tax payments. So your April surprise is not a good one like you're used to. It's now you owe $10,000, $15,000, and some people that's a very meaningful number, and it's hard to come up with when you're needing capital to start a business with. So we like to always be involved in the creation of the businesses and the planning for the businesses to point that out and say, now that you've transitioned to this is what you should expect going forward. And one of those items, estimated tax payments. The other thing we see is there's a form called the 2210 that tracks whether or not you paid the right amount of estimated tax payments in when you were supposed to pay them in. A lot of preparers are lazy, for lack of a nicer thing to say, and they don't take the time to fill this out correctly, and it can end up costing taxpayers thousands of dollars.
Another issue that we see a lot of tax returns are underpayment penalties because they didn't pay enough tax in throughout the year. And kind of a big thing this year, I don't know if a lot of people maybe read articles about it. There's been a lot. Wall Street Journal, I think, just had one, this week, but they're talking about how so many Americans are going to be underpaid this year because of the withholding tables that the IRS came out with at the beginning of the year. With the tax law change, IRS kind of redid all the withholding tables, and it turns out that they're not as accurate as they need to be. And so a lot of Americans are finding out that they are going to be under withheld. They might actually owe taxes this year, which a lot of Americans, I have several friends that actually use refunds as a money-saving policy or
a way in which to save, force savings,
yeah,
if you will.
A way, which my opinion is a terrible idea. IRS, you never want to give them more money than they need. Interest-free loans, they call it. The IRS has realized that, they did mess up the tables, and so there is going to be a lot of people under withheld. And so they've come out kind of with a short-term solution. For tax purposes, you're supposed to have 90% of your tax paid in by the tax return due date by April 15th. So now they've come back and said if you have 85% paid in, you're not going to be charged those underpayment penalties. So it's not as much as I think they should do, but it's helpful.
All great points, guys. Thank you. Thanks again for downloading this episode of Your Life Simplified, which is produced by Mariner Wealth Advisors. And at Mariner Wealth Advisors, we're here to serve as your advocate. We help people chart a course to reach their personal and financial goals so that they can have greater peace of mind that may lead to a more fulfilling life. We do this by always putting our clients first. Because as fiduciaries, we're required to provide guidance that's in the best interest of clients, not in the best interest of a company or shareholders or anyone else. So as you listen to this podcast and have questions about maybe your own financial situation, or would simply like a second opinion, or even you have an idea for a future podcast, please go ahead and email us at podcast@marinerwealthadvisors.com. If you found the information on this podcast valuable, please go ahead and share it with a friend or family member that you think might benefit from this information. And please don't forget to subscribe to this podcast so you don't miss an episode. Thanks for listening, and now back to the episode. So Ryan, I know another thing that we see quite a bit of is you have a husband and wife, and one of those individuals works for a company in which they have access to a 401k or some sort of plan that's company sponsored, whereas maybe the other spouse is working out of the house, side business, independent contractor, like you just mentioned a second ago, and that they don't take advantage of the retirement accounts that might be out there for them, and that could be a mistake.
I think absolutely. What I have seen a lot of is individuals just don't realize what their options are when they leave their employer. And for 30 years, they've had this access to either a pension plan or 401k that their employer provides. And now they kind of just assume that they're stuck on their own, building their investment assets through a Fidelity or a Schwab account. And they don't realize that there are several self-employment 401ks, there are self-employment retirement plans that are actually a deduction to them, and depending on how they're structured their business. And what I like to tell people when they come in and we talk about this and we say, well, you could contribute to your SEP plan, your self-employment pension plan. And the reason you really want to do that is, like your traditional 401ks, it actually lowers your tax liability. So the government is still kind of stepping in and subsidizing or assisting you in getting to your retirement goals.
And guys, one of the interesting things I think that's coming out of this conversation is that there's a lot that goes on throughout the tax year. And I think that people look at the tax year, January through December, and oh, by the way, there's this event on April 15th where I need to file my taxes and get that done. And I think that's a bit of a misnomer. If you think about all the things that happen within someone's life throughout the year, and to not engage with someone as it relates to their tax situation, to be able to take advantage of opportunities or mitigate issues as that tax year goes on, because once you hit December 31st, you no longer have that opportunity to make those decisions. And I know, just prior to us recording this, we were talking about the conversations that people are having, today with their tax advisors. And hey, is there something we can do from last year? And that window has almost for all intents and purposes closed because they should have been having these conversations throughout the year, like you guys do, with clients.
No, I think that's a great point. And what I would like to emphasize is if you leave this podcast thinking nothing else other than in 2019, what do I need to do? You need to be focused as a person concerned with your tax situation and profile with income events and with life change events. So the best time to talk to your advisor is really anytime you're uncomfortable with an issue, number one. But number two, if you know you're getting a large bonus, well, maybe you should talk about how that withholding should be or what you could do with that. And it's a great conversation for your wealth advisor or your tax consultant. Or if you're getting married, that's a great opportunity to bring in a tax person and talk about, okay, well, what are your finances going to be when you're married? What are your retirement savings going to look like? What are your tax returns going to look like going forward? If you're having a child, again, now there's this $2,000 credit instead of one with greater income thresholds before you lose that benefit. So anytime you have these life events or you have these income events, whether they're loss of a job, a better job, a promotion in your current job, these are great times to really work with your advisor.
So to kind of add on to that, another big reason to reach out to your tax advisor is anytime there's a big tax overhaul, which happened in 2017.
So to take that a step forward, once you've completed the tax return, so someone's working with their advisor, maybe even they're doing it on their own. I think generally speaking, whoever it is that prepared that return signs off on that return and sends it in. But what kind of dialogue or opportunity is there after all these documents have been produced? Again, I think a lot of times they're big, scary documents and everyone just wants to electronically file these or put them in the mail and be done with it. But isn't there an opportunity after all of this data has been collected and put through this formula, if you will? Is there an opportunity at that point?
I think so. And even if you can't go back in the past and change what happened, you can always be more active on what's going to happen. And I think it was on a previous podcast from this series where someone was talking about it's always a great idea to know what's coming up and always to be proactive so that you can limit surprises. And if you have an idea of if your financial plan is working for you, taxes play a big part of that. And the surprise mitigation is a wonderful tool that tax consultants can bring to the table with that. And kind of what I mean by that last confusing sentence is if you unpack it a little bit and you take a step back and go, my financial plan for 2019 is to do these three things. Are those three things tax focused? And not everything in life needs to be, but if my goal is to save $20,000, what's the most tax efficient way to save $20,000? And not only today, but in the future, depending on what stage of life you're in, you might need that $20,000 in 30 years, you might need it in 5. In addition to that, if I am going to save for my kids' college tuition, or I know I have my child's college bills coming up soon and I'm planning on helping with those, is it time to start a 529? Have I already done that? Am I at my limit for those items? So as you get all of these documents prepared and you sit down and you talk about your tax return with your preparer, or hopefully your consultant and advisor, you can ask the questions of, wow, that's surprising. What could I have done differently for next time? As well as, okay, here's what my next year kind of looks like and my goals are, and how can I fit some tax efficiencies into those?
Right, great points. The two that I took away immediately was being proactive. I think a lot of us are reactive as it relates to our taxes. As I mentioned, we get the return done and we want to get it out. We want to file it immediately. But what clues can we find in there, and how do we have that conversation throughout the year to really affect change and implement strategies where appropriate? The other is, of course, we all pay money in taxes, all of us. So some of us pay more than others. To have a plan as it relates to taxes and be proactive just makes sense. It's like anything else.
Agreed.
So Ryan, for those that are listening that are not currently working with a tax advisor, can you talk a little bit about what to look for in a tax advisor, maybe the difference between maybe what you see on TV, like a tax preparer versus a true tax consultant, what that might look like?
Yeah, I think that's a great question and something that's near and dear to everyone's heart. You want to make sure that if you're going to pay someone to help you with something, you want to know they're qualified and you want to know that they're doing what you need them to do. And with taxes, that's just so complicated. In college, I had a funny professor that one of the most memorable things he said is, taxes aren't that complicated if you have a critical mind and you can read instructions. And what he meant by that is it's easy to get a form right. You can look at a document that's got tax numbers, read the instructions to that document and the 1040 that you reported on or whatever form you reported on, and you can get technically right answers. What a tax preparer will do is likely that you will take your documents in, you'll sit in front of them, they'll give you 30 minutes of their time, and they will put numbers in boxes, and they will likely be correct at the end of the day. If you take a step back and you find a tax consultant or advisor, or someone that really lives and breathes taxes and loves helping people, what they're going to do is they're going to get you a right answer that's also the most right answer. And in today's world, that sounds rather funny to say, but it's absolutely true. Just because you've got the same fact pattern with client X and Y, they can have wildly different tax answers if you sit down with someone that looks at a more holistic approach, that takes a step out of the forest to view the entire forest instead of just the leaves on the trees when you're avalanched in the documents. And how you find that, that's a great question. How you find anything, really, word of mouth, referrals, just having a CP in your name, that just means you passed a test, and it's a good first start. But I know a lot of people like my father that taught me taxes when I was 14, and he gets it as well as some of the people I've helped develop through their careers. But really, word of mouth is the best way to do it.
And I'd say, what's so great about Mariner is that, we kind of have this all in-house to where, we do work so closely with the wealth advisors, and the wealth advisors should know, the clients, what their financial goals are, what they did throughout the year. And so being able for two teams to talk to each other, is really beneficial. So I'd say, a great place, if you, to find, a CPA is to talk to your wealth advisor. A lot of them have relationships with CPAs. So I think they're a really good place to start for recommendations.
Guys, that's terrific. Really appreciate the advice. As we wrap up the show in the same way each time, and that's by asking what your worst financial mistake has ever been. So, Ryan, we'll start with you.
I had children. I love them. No, in all seriousness, they are a sunk cost and a money pit, but they are lovely little critters. The worst mistake I've really ever made financially is I bought a home before I should have. At 25 tender years of age, I had just gotten my first big boy job. My wife had just graduated, and we knew without a doubt she was going to be an educator. And then 2008 hit with the financial recession, and we bought our house anyway, and she didn't have a job, and they basically let a bunch of teachers go in our area, and she still doesn't have an educator job. So for many years we were under for that, but we clawed our way out of it. But hold off on buying things that you shouldn't. And
just to be clear, your kids, are they listeners of the podcast?
No, they're 8, 6, and 2.
Just making sure.
It's not on YouTube, so
try to keep you out of trouble.
Be on there. Yeah.
Erin?
I was talking to Ryan about this earlier, trying to figure out, what my biggest financial mistake was, and I was claiming that I never had one. Then it occurred to me that, a few years ago, I basically was living off no budget, having no idea really where my money went, until I finally straightened up and got myself a wealth advisor. And now, I'm on top of it. I know my retirement accounts are all set up. I got my investments. So a little nest egg I've started. So my biggest failure turned probably my greatest achievement.
Well, that's great, guys. Thank you very much for sharing that. We'd rather ask you that question versus, the best financial decision you've ever made. So
I just gave you mine.
That's true. You did. You're absolutely right. So, guys, again, I know it's a busy season. It's a busy time for you, but thank you very much for taking the time to join us. And I also want to thank our listeners for taking the time to listen to this podcast. For those of you that are listening and have questions about this topic or would like to provide us topic ideas, please go ahead and feel free to email us at podcast@marinerwealthadvisors.com. And if you've liked this podcast, please go ahead, maybe tell one or two people about the podcast and where they can download this wherever they listen to podcasts themselves. Thank you very much.
Mariner LLC, doing business as Mariner Wealth Advisors, or MWA, is an SEC registered investment advisor. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which a notice has been filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money.